Hello, everyone. It's noon in London, and it's time for the latest NOCA CPD event. I'm Rudolf Kutzer, and we'll be hosting today's session. Just please note, this event can count towards your IFOA CPD requirement if you consider that you have learned something relevant to your current or future actuarial work or professional development, that it addresses a personal development need and has an identifiable learning outcome. Our presenters today are Anthony Plotnak and Kenny McIver. They're both from WTW. Anthony is a director in WTW's insurance consulting and technology business. He's an experienced capital management, ALM, and investment actuary with over 17 years experience in the life insurance industry, including 8 years of consultancy experience. Prior to joining WTW in August, Anthony held senior roles at the Just Group, Canada Life UK, Retirement Advantage, and EY. Kenny is a director in the insurance consultancy and technology business as well. He joined WTW in 2008 and was based in Sydney from the end of 2015 to early 2019. He has consulting experience in most aspects of life insurance, having worked in the industry for almost 15 years. Kenny co-authored 2 WTW reports in 2022 on the Solvency II Reforms, working with the industry via the Association of British Insurers to analyze the potential impact of the proposals. He is a leader of the ICT Life Team's UK regulatory team and is on the IFOA's Life Research Subcommittee, the IFOA's Dynamic Discount Rates Working Party, and the ILAG Prudential and Regulatory Practitioners Group. Today's title is UK Solvency II Reforms. And I think you'll all appreciate very topical, given announcements yesterday. Also, given announcements yesterday, we have not yet uploaded the slides to our website, rather giving our presenters time to make as many timely changes as they needed to. But we will do that afterwards. The presenters are going to present and we'll have Q&A session at the end. So if you want to raise any questions, please put them into the chat box and we'll get to them after that. And with that, I'm going to hand over to Kenny and Anthony.
Thank you for that introduction. That's excellent. So yeah, the title of our talk today is UK Solvency II Reforms. I realize that we can actually be much more concise with that title and call it Solvency UK as a term has been coined. Yeah, we were looking at something around about 40 minutes of presentation and 20 minutes of discussion. We think there's a lot of scope for discussion on this topic, appreciating that the information is relatively new and some people may be going through that, but we'll like to get to that later in the session. Please, of course, chime in with any clarification questions as we go, but we'll try and leave the discussion towards the end. Okay, I'll start with a disclaimer quickly. The views expressed in this presentation are those of the authors, Anthony and myself, and I should also give credit to Ed Hawkins and our team who's done a lot of work to bring this material together for us. They do not necessarily reflect the views of WTW, and indeed I'll let you in on a secret that Anthony and I don't share the same views on some aspects too, so we'll come to that and really appreciate your input on that later. Yeah, it's very much focused on life insurers and annuity providers in particular. I'll say one more thing on the disclaimer point. We do not have individual firms' data in this presentation, but we have included one slide on the aggregate data, which is in the public domain when we reviewed the results of the quiz in 2021. So agenda, we have 5 items on the agenda. So I'm going to take us through the overview of the reforms timeline. So that will be a quick canter through what's happened already and take us up to the latest developments from Treasury and PRA yesterday. We're going to move into the implications of the reform package, and I'll cover some of that and Anthony some of the rest. And then we'll go into analysis. That analysis will really focus on the risk margin and the matching adjustment. Further reforms here, we really are referring somewhat mainly to the reporting reforms as well, which we want to cover. That was a little bit earlier in the month. And then we'll move on to talk about the Treasury objectives. And then at the last point, we'll stop as where do we go from here? And that's where we'd invite some discussion from the team. So here we have the timeline. So I've broken this into Treasury, the PRA, and WTW at the bottom there. So if we go all the way back to 2016, that's when we had Solvency II implemented in the EU. It wasn't too long until we had the referendum on the UK leaving the EU. And shortly after that, Treasury Committee launched an inquiry on Solvency II, and that was really a blank page soliciting high-level views on the opportunities following Brexit. Treasury, we responded to Treasury, and our response there is in the public domain. They did eventually release a report at the end of 2017, and the PRA commented on that a little later. And then there was a hiatus. That's what the dots represent there, and would take us all the way to 2020. And then we saw the Treasury release the call for evidence. Now, the call for evidence was seeking inputs on what we were actually divided into 10 key topics or chapters in that call for evidence, and really very much a blank page to work up from for reviewing Solvency II, or reforming Solvency II, I should say. There was a matching adjustment section, and say that matching adjustment section focused on asset eligibility and did not really cover fundamental spread calibration in any detail. And then WTW, of course, also provided our response to that call for evidence, pointing out some of the opportunities in those areas. Treasury responded a little later. That was very much a roundup of the responses they'd had, so not a lot of excitement in there, I would say. But it did get exciting when we saw the PRA quiz release very quickly afterwards. And that had two exploratory scenarios, scenario A, scenario B. They were not bookends for future policy, and they were risk margin benefits offset by matching adjustment potentially being of less benefit under those two scenarios, extra scenario A being more extreme than scenario B. So we analysed that data, we produced a report. That was work done with the ABI. We covered 75% of the UK life market by technical provisions and commented on the implications there. And we suggested potential ways forward, including greater granularity in that fundamental spread calculation as one way to address some of the PRA concerns there. And then we had the Solvency II consultation, which is in more recent memory, and that was accompanied by the PRA discussion paper. That discussion paper, DP 222, was really setting down the stall for the PRA on why they felt this new index spread model, which was proposed then, was the way forward. Higher calibration, shorter averaging period for spreads, and linked to current spreads via that index spread model. And then the data collection exercise followed that, which is completed just a little earlier this year, and that covered evaluation methods by asset type, asset level data as at year-end 20, and the balance sheet impacts for and SCR for that index spread model. And around that time, we also produced our analysis of the reforms, which is another piece of work we did with the ABI. Now, the latest updates, which we all want to get to, of course, are these three at the top right corner of the slide. The HMT consultation response, which was published yesterday alongside the autumn statement, and accompanied by feedback statement 122 from the PRA. And then we also should note here a little earlier, we had the Solvency II reporting reforms via CP 1422, or consultation on phase 2 of reporting reforms, which would be effective at the end of December 2024. So let's dive into that consultation response that we saw yesterday. So we've broken this into 5 key areas, and starting at the top with matching adjustment and the risk margin. So matching adjustment index spread model is not in that paper. They are looking at maintaining the existing fundamental spread methodology and calibration. So that comes over very much as good news, I would say, on its own. And introducing allowance for notch ratings, no more granularity in that calculation. On the risk margin side, confirmed that, again, tapered cost of capital method is the way forward, and suggested that for long-term life insurers, somewhere in the range that they originally proposed of 60 to 70% reduction in risk margin, they would target 65%. No detail on how that would be achieved via the calibration. That's presumably to come later and possibly in the gift of the PRA. On investment flexibilities, they've coined the term highly predictable cash flows as assets with this criteria would be able to be included, albeit with some stipulations. They've confirmed that they'll extend the range of liabilities eligible for the MA, which previously been discussed as including items like income protection being included there, removing the sub-investment cliff edge, and talking about again about a more streamlined approach to MA applications. On reporting requirements, similar stuff as was out in the consultation, lesser requirements for UK branches of foreign insurers, doubling, actually potentially more than doubling, in fact, in the latest paper, the threshold for insurers becoming required to undertake Solvency II, and again, reducing the reporting administrative requirements, much of which is covered in that Solvency II reporting phase 2 paper consultation. And some interesting things on supervision, which Anthony will go into more detail. I'll just quickly summarize here, but the requirement for insurers to participate in regular stress tests, senior manager attestation for sufficiency of the fundamental spread, the ability to apply fundamental spread add-ons, and requiring further assurance on internal credit ratings. That's a quick roundup of what we saw yesterday in that HMT consultation. There's also the feedback statement, which I'll hand over to Anthony on now.
Yeah, thank you, Kenny. So I suppose, yeah, we've heard really there on what consultation response from Treasury. We perhaps haven't yet heard from the PRA any views around that consultation response, but they have published what they've called a feedback statement on their original discussion paper that came out at the same time as the consultation. Perhaps slight irony here in FS being very much obviously the same acronym as the fundamental spread, which has been much of the debate around the topic of Solvency II reforms. But this is where we've just drawn out some of the comments that we did see in that paper that might be useful to think about. That paper is generally fairly factual. It summarizes the responses that the PRA did receive to their discussion paper. I suppose this first box very much highlighting that, in terms of the direction of travel of the fundamental spread, it does seem that Treasury has taken on board essentially the feedback it was getting, and that generally the suggested solutions by industry as a whole to move to a more granular approach. That was effectively an attempt to address some of PRA's concerns around the fundamental spread not being risk sensitive enough. But this concept of kind of having more graduations in ratings, in line with a full rating spectrum with pluses and minuses, or notching as it's termed, is essentially a way of recognizing that a minus rating will have a higher, probability of default and downgrade than a plus rating. So again, we don't yet have the detail of how that would be implemented, but it should prevent some of the worries that perhaps the PRA had around portfolio shifting into lower credit quality assets in every bucket to maximize the matching adjustment and the spread, with some greater allowance in the fundamental spread for those lower negative rating buckets. So again, once we see the detail, we can comment more. We do have some analysis that we did prepare on this in our original papers. I think the second key point here is this acceptance, perhaps again through the respondences to both the Treasury and the PRA, that the current fundamental spread does allow for a cost that's materially higher than the historic cost of default. I think a number of 2.5% was also mentioned in the consultation response, similar to our analysis. But generally a view that already allows for margins for uncertainty, and that generally the matching adjustment regime is working well. I suppose that does then kind of lead to the kind of response we seem to have had from Treasury to largely leave the matching adjustment untouched. I suppose some of these other comments then perhaps start to think more about the impacts of the changes. So this grey box, very much talking about annuity provision and pricing, investment in productive assets, which was part of the original objectives, and use of insurance. So PRA have set out some views on this in recent speeches, but generally the good news that the matching adjustment isn't changing, hopefully kind of means that the strategies that insurers follow are not detrimentally affected. I suppose we will come on to more kind of as to views as we go through the presentation and discussion as to what that really means in the context of the objectives of Solvency II reforms, and essentially, the amount of investment in protective assets that has been kind of publicised in the press generally around Solvency II reforms, and obviously the growth plans that Jeremy Hunt, and his statement sets out. I think the final few views here. Again, there had been comments on, well, will insurers necessarily use any capital release to invest in such assets? Could it be used to increase dividends or remuneration? So that again is something that still isn't necessarily addressed by these reforms. Some statements around capital ratios in the half year results, but again, generally the kind of the stabilizing of balance sheets and removal of volatility is seen as a good thing for the ability to pay dividends, and generally the strategies of the insurers, in particular the bulk annuity players, is to invest in long-term assets. So as we'd commented in our previous reports, if you really strengthen the fundamental spread, that possibly has a negative consequence on the long-term investment. And I suppose what seems to be the good news is that the index spread model and that kind of heightening of fundamental spread and volatility of fundamental spread has been pushed aside. I suppose our final comment here, I think Kenny had touched on some of this before, around the 65% effectively being set at the middle of the kind of 60 to 70% range. The PRA had previously said that they felt that 60% was very much on the edge of what they would see as acceptable, and in terms of the soundness of insurers and protection of policyholders. That they'd also previously said that they felt that a 60-70% reduction in risk margin would need to be accompanied by significant changes to the fundamental spread and the matching adjustment. Obviously those significant changes appear to not have been put through. So again, where does PRA now sit in the context of the risk margin release? And what effectively is that risk margin release measured against? So that's where we'll have some further discussion. If you can move the slide on, Kenny.
There we go.
So we've tried to set this out slightly as a terms of tipping the balance. Obviously, generally, the kind of the package of reforms now seems to be more in the favour of the lobbying that the insurers had been doing over the last kind of year, since the quiz and the index spread model first came about. So it does seem that the index spread model has been put to bed. That link to spreads isn't going to be brought into the kind of underlying fundamental spread tables. We do expect some release of capital from the risk margin. Again, once we see how that will be implementing, we could give more of a view on the quantum. Whilst the kind of John Glenn statements at the beginning of this, mentions a 10 to 15% release of capital, it is notable that the latest statements doesn't refer back to that. So again, we can infer what we think it might be, but no specific target set this time. Obviously, we've talked about the changes to the matching adjustment, the removal of the BBB cliff. Again, perhaps seen as a positive for the industry, although the proportions of assets allocated to sub-investment grade would currently be low and wouldn't necessarily see that increasing as a result of this change. Obviously, risk management practice still needs to remain, and limits will be in place. And then the ability to include further assets and liabilities into the portfolio obviously does potentially unlock further capital benefits and just benefits in terms of the long-term investment. Again, it remains to be seen what the specific criteria around this will be, and the highly predictable definition obviously is also an area that's not clear what exactly that implies, and how much scrutiny or extra scrutiny you might get to include assets on a highly predictable basis versus a fully fixed basis as per the existing rules. So these things, and potentially some reduction in the processes for application and reporting, generally seen as the wins for the insurance industry. On the other side of the coin, the PRA has, through perhaps negotiations with Treasury, included these 4 additional effectively requirements on matching adjustment into effectively the kind of response. So we would expect to see more scrutiny from the PRA over firms matching adjustments. I think this attestation is very interesting, so pushing more of the burden of proof to that senior manager responsibility. Some talk in the response as well around extra scrutiny on ratings. So albeit the PRA has already reviewed and scrutinized a lot of the internal ratings approaches, we can expect more of that, I think. More rigorous analysis, and also this stress testing type concept that's been introduced, similar to I suppose the banks, where again it's been stated that the PRA would have the ability to publish individual firm results. Now again, we don't know exactly what that stress testing might involve, but it does indicate that the PRA would have the ability to set those stress tests and also report on them. So I think, yes, some of the people we've had early conversations with quite worried about these additional requirements, not just from the concept of how much extra work it is, but effectively also the fact that it pushes more of the power to the PRA to scrutinise these areas, on a firm by firm basis, rather than I suppose the existing regime where you kind of look up the fundamental spread from a table. So the types of discussions that perhaps we have on internal models, being pushed into the base balance sheet as well. So yes, whilst overall, a positive in terms of where the debate had been, to date, if you compare this to the current Solvency II regime, is it necessarily an improvement on where we are today in terms of how we would have perceived this right from the start? So insurers were wanting the things on the left, but they weren't expecting the things on the right, and we weren't originally expecting any changes to the matching adjustment calculation. So if you look through it through the lens of perhaps the period we've been through in lobbying over the last 6 months, yes, it would be viewed a win. But if you looked at it from the lens of what we started with in terms of expectations for the Solvency II reforms, how do we really feel about it? So yeah, if we move on, this was some early analysis we'd done some time ago, actually, on notched rating. So we haven't attempted to update anything here from what we previously included in some of our reporting. But it is, just emphasising that there could be, even if you have an evenly weighted portfolio, some increase in fundamental spread, not as extreme as the levels of increases we were seeing from the PRA's calibration of their index spread model, but depending on how you effectively implement this. So we're not yet clear, would there be tables published for the full notches, or will some interpolation approach be used? Here we used a linear interpolation, not necessarily suggesting that linear interpolation is the right thing to do, but as a simple way to assess it, we'd looked at linear interpolation, and you can kind of see the impacts that you might get if you had then an evenly weighted portfolio versus portfolio that's more weighted to the negative buckets today. So obviously the more weighted you are to lower quality assets, you would perhaps expect a bigger impact from this type of change. But again, the industry was generally accepting that was a sensible risk management type change to include, and also the ability perhaps to use rating outlooks to adjust your fundamental spread. So again, fundamental spread add-ons have been noted here as possible of these additional measures that could be brought in. So those are add-ons that the insurer could set themselves, if they have particular concerns around individual assets, or they could be things that get left to discussions with the regulator around particular asset classes, the portfolio as a whole. Again, we're a bit unsure, at this stage. But yeah, some warning around, yes, you'll read the existing fundamental spread tables, but there's perhaps more ability for scrutiny of those base fundamental spreads with add-ons than possible. I think I was going to hand back to you now, Kenny, for analysis of the risk margin impact.
Thanks, Anthony. That's right. Yep. Let me take you on. So again, we've leveraged off of previously undertaken work. So actually, this table bears much resemblance to one which we published in a similar report that Anthony was referring to there, our 21 July 22 reports on the analysis of the impacts. So here, what we've done is we've taken an illustrative in-payment annuity portfolio and determined the reduction in risk margin that might be expected based on different calibrations of this modified cost of capital approach or tapered cost of capital approach. As you're probably aware, there's two key parameters in that approach. There's a lambda factor, which is a time-dependent factor that reduces the cost of capital, reduces more for durations further into the future. There's an apostrophe here because, an asterisk, excuse me, that lambda is some of the formulations of this modified cost of capital has a floor in the lambda. So at a cumulative level, lambda, for example, wouldn't go below 50%. These are the annual lambda factors shown here. And cost capital rate is per the normal approach. Of course, that would feature in the modified cost capital. So we show the current approach, which is, it could be framed as 100% lambda, 6% cost capital, and no floor, of course. So under a year end 20, when the quiz was conducted, and is often been seen as a reference point for figures that have been quoted even in the in this year's HMT consultation that came out on 28th of April 2022. But we've also moved the analysis forward to Q3 2022 as well. And so on the current approach, we're using both of those as a baseline in these two columns on the right. We then stepped through what was the original European Commission approach, which was 97.5% lambda and 5% cost capital rate, and that reduced risk margin by about a third, coming through almost equally between the cost capital rate reduction and the lambda factor there. And we see at Q3 2022 that's not moving greatly when we do the same calculation to work out the impact of the reforms purely. Now, if I step through, then we have the EU Parliament approach, which is actually the rapporteur's suggested approach, and this is still subject to some debate, so that these are not finalised approaches in the same way that Treasury is suggesting a final approach here. But that had a 90% lambda and a 4% cost capital rate, and we were looking, at least in today's terms, about a 65% reduction in the risk margin under that approach, purely from the reforms. Now, in April, that consultation from Treasury had an upper and lower range of 60 to 70%. What we showed here, and these are just illustrative, we set out what the lambda and cost capital rates would be to achieve that. Now, obviously, you could have other solutions to give you that results, but these were actually quite nice rounded results, which did seem to achieve that for our illustrative portfolio, at least at year end 20. It got dropped a bit further in Q3 2022. Now for November, we don't know what these calibrations will be, which I mentioned earlier, but we do know what the target is. Now, and we've expressed it here I've expressed it here in this table, and this is where maybe Anthony and I divert in view that 65% could potentially come through as a change purely from the reforms, and this is shown at Q3 2022, but it wouldn't, as we see from the comparison between year end 20 and Q3 2022, that wouldn't necessarily change much over time. But the important point, of course, that presumably we're quite well aware of, is that risk margins have dropped quite considerably between year end 20 and Q3 2022 on their own, and that's because of the rise in interest rates. So if you were looking at a change in risk margin that was from year end 2020 and was a combination of the economic environment and the reforms, then the reforms would only have to deliver a small fraction above that 60-odd% we've seen from the interest rate movements. So that's one potential interpretation of the Treasury statement. One interpretation I particularly favour, though, is that, maybe for obvious reasons, is that reduction is coming purely from the reforms, but that would be quite a severe reduction overall. If we looked at that compared to year-end 20, that would look at an 85% reduction from the year-end 20 risk margin, partially from interest rates, partly from the reforms. And then it's probably worth mentioning too, when cost of capital approach was conceived back in 2006, by year-end 2020, the risk margin had already grown by 75% odd, so it had already gone up to quite a severe amount over that time, and we expressed that in one of our previous public reports. So actually the interest rate changes has really just brought that level back down to around about what it was in 2006 from interest rate movements alone. So it is the big question on our minds is Treasury looking at an additional 65% there? Okay.
Yeah, I suppose I would set out perhaps some of the counter view a bit more in that if you actually read the detail of the consultation response, they do use the wording that the original 60 to 70% range was looking at 60 to 70% on the basis of recent economic data. Now we know that obviously the data that was looked at was at year-end 20. The consultation itself was out in April, but probably the work underlying pulling that consultation together was in the early months of this year, and we'd had some movement in interest rates, but obviously not the extent to which we've seen in more recent months. And again, they seem to have targeted the middle point of that range, and again in paragraph, I think it's 2.1 and 2.4, that the commentary they give uses the same wording, and therefore my reading of that is when they're talking about 60 to 70% on the basis of recent economic conditions, they mean the recent economic conditions when the consultation was originally being thought of, not the recent economic conditions we see today. Now obviously if you had brought these changes in at year-end 20 and it had plumped for the kind of 90% lambda 4% cost of capital rate, and brought those changes in at year-end 20, we would see further reductions, as Kenny points out today. But I suppose what we're kind of urging caution on is that the regulator is perhaps involved in calibrating this now, and will calibrate it based on their views around the current environment. So one of the statements I pulled out before from their FS was that they viewed the 60% was again at the border of what they could view as acceptable for a risk margin calibration based on the conditions at the time. So they used the words the prevailing conditions at the time of the DP. So again, it's important to factor in the interest rate movements into how this get calibrated, and ultimately I suppose what we're most wanting, and what the risk margin reform has always been about, is making the risk margin less interest rate sensitive. So the big problems came as interest rates fall, and actually year-end 20 was probably the low point of where interest rates got to. We're away from that low point now, and we may view that interest rates are going to continue to rise to control inflation, with bank rates going up further. So you can only see that the risk margin will fall naturally before these changes even come in. So will that change have effectively already happened, and you have no further change from effectively a day zero or day one implementation of Solvency UK, as it's been termed? We were thinking of having some kind of poll or vote on this. I don't know if that's going to be possible, but
yeah, I was going to say the same thing. Yeah, I think it would be really good to hear thoughts from the group here, and certainly a sentiment I share from Anthony is that we definitely urge caution on this interpretation. Okay, I'll take us on here, and moving into sort of slightly older territory, but still highly relevant for some, is the proposed Solvency II reporting reforms that we're now in phase 2 of this process, and the PRA have stated that a burden imposed by firms should be proportionate to the benefit resulting from the imposition as one of their guiding principles on this level of reform. So it's the second phase here. Phase 1 reporting changes have already been stated and taken effect. There's a removal of sort of low-hanging fruit on selected reporting requirements, and some waivers on quarterly reporting requirements. Now, phase 2 covers what are deletions, changes in reporting frequency, amendments or consolidations to existing templates, and some additional reporting requirements. I have a quick summary here. It doesn't actually give a real strong sense of effort across these, but it does give you a sense of scale maybe. So I'm counting, and so there may be some uncertainty in this in terms of how you would classify these, so please take care of it. About 10 QRTs that have been deleted, 7 QRTs with new thresholds for reporting them, 3 QRTs with new frequencies of reporting, 4 QRTs with new for life reinsurance, and that's indeed the 4 new templates I mentioned here on the slide. 4 QRTs that have been replaced, and they focus on the SCR, and various other QRTs which I would describe as being consolidated or amended. So quite a bit of change across this cost of reporting for this, and also additional reporting on new topics, 2 of which are relevant for life insurers, which is the excess capital generation and cyber underwriting risk. And then there's also a non-life obligations analysis, similar to what exists for life firms. And the PRA has estimated a median cost reduction due to these changes of 23 million per annum across the industry. It does warn that that is quite an uncertain figure, and there was some limited responses to sort of substantiate that, but they also claim that there is a more optimistic number of something, I think is 46 million per annum at the higher end of the potential range of cost reduction. There's some important other pieces around this. So actually, PRA will consult later on other areas of reform, so the risk margin, match adjustment, TMTP, internal models, and the areas of their disclosure. And the intention there is to ensure that the approach is buttoned down, and so that the necessary areas of disclosure can be confirmed at a later date. The PRA is also planning to review the existing requirements of the SFCR and the RSR with a view to consult on these. So these not being included in this phase 2, but they have been mentioned as a future area of focus. I would also say that the consultation period for this is 6 months, so it's longer than we'd normally see. It could be one of, or both reasons for this. Could be we're obviously going into winter and holidays, so there may be need for more time, although that's not necessarily meant longer consultation periods in the past, but also the reporting cycle coming up might mean that we need some time following that as well. Another reason I've someone shared with me, of course, is that there could be some dovetailing into one other consultation on reporting requirements, which could be one of the ones I've mentioned here. So worth noting that that deadline is not until early May. Okay, so we're coming to wrap up actually, and we're doing okay for the time I suggested that we have for this. So you'll recall that there was 3 objectives set out by Treasury for the reforms, and we've always kept these front of mind as we've considered the impacts and what's been suggested. The first is to spur a vibrant, innovative, and internationally competitive insurance sector. That we've often pinned to that the question of, well, what will be the release of capital here and how that capital may be used. There was we haven't made too strong reference to it, but there was back, not in too further distant memory, was John Glenn's statement that they would be targeting 10 to 15% release of capital under the proposals. That's not been repeated again in the latest ones, and some back of the envelope suggests that what we're looking at here would not achieve that. However, things have clearly moved on. The other piece is also that the FSM bill has progressed, and PRA is looking at including a secondary objective of growth and competitiveness in its principles. The second objective is protection of policyholders and the soundness of firms. A point that's been made throughout this process is that policyholder protection must accommodate both current and future policyholders, so ensuring that, for example, insurers have the ability to enter the security of the insurance regime now and into the future, and not overcapitalize or restrict that ability. And the third is a key one here too, is supporting firms to provide long-term capital to drive growth in productive finance, productive assets, and that's an area of particular focus here, as we've previously had concerns that some of those assets that would be targeted there may not have the same, may be reduced in attractiveness under the previous reforms. But Anthony, I'll hand over to you to any other remarks, particularly on that last point.
Yeah, I suppose the kind of objective here is obviously very much around investment in the UK. There has been some perhaps queries around particular assets in the existing regime that might have high spreads relative to their rating. Obviously that's some of what PRA was setting out in its concerns, and why it kind of suggested a more spread-based calculation, perhaps with a lot of focus on these types of assets that might have a lot of protection within them, but still have what appears a high spread relative to their fundamental spread. Obviously given the kind of views around the current regime remaining in place, but with these safeguards that effectively PRA points back to objective 2 here. That is repeated within the reason for these additional measures that the PRA maintain. So whilst we're hopeful that the breadth of assets that can be included and the time to include new assets and the processes to go through to get those approved and into your matching adjustment will be reduced, I think there's still very much lots of questions to answer around how this ultimately would be implemented. As I said before, highly predictable isn't defined, and the quantum of how much can be highly predictable rather than fixed also is not something that's been particularly commented on in detail. So overall, whether this drives the types of investments that the government is looking for, I suppose it's still to be determined, but the insurers obviously very bullish around moving into more of these types of long-term productive finance assets, and will continue to kind of want to do that to back their BPA schemes that are coming in. We've obviously whilst we've experienced a period of crisis in the pensions regime, that possibly means there is more appetite for pension schemes to transfer into the insurance regime going forwards, and also the rising rates, meaning their kind of buyout pricing bases are perhaps more achievable. So overall, it should have a positive outlook, we think, in terms of how the matching adjustment is remaining broadly as is. Should allow more continued investment in these assets going forwards. I think our final slide really was just reflecting back. If you move on, Kenny, on this kind of 10 to 15%. So we'll finish probably on this one and then invite discussion and questions. We did have a few discussion topics that are coming up on our final slide. Here we're probably suggesting we've moved from the index spread is 35% in orange, quite a large range across the insurance industry as a whole, but negative triangle there is where we saw it for firms that are very specialists on annuities or potentially new business annuities. I think we'd previously had worked out that the index spread model at about 22% or 21.5% maybe it was broadly similar to today. So this CRP of 25%, whilst this model is not being used, probably gives an indicator of perhaps where the matching adjustment may be adding. So slight adjustment to the current levels of matching adjustment with some ability for add-ons plus notching, potentially skewing it slightly upwards. So this may be a broad estimate of where you'd end up. I think again here we were showing a 60% reduction approximately for risk margin, so we're now moving to 65, so it's slightly better than what we showed here, and we're allowing for the TMTP recalculation. But as you can see, for the kind of life annuity type firms, that was broadly a neutral outcome. So it's obviously better than a negative outcome, but we're not necessarily seeing it as necessarily leading to large increases in capital beyond those that we've already seen from interest rate movements anyway. Again, dependent on this view of where the risk margin calibration actually is now intended. So this is all focused on it being effectively a 60% move from year end 20. Are we now at 65%, or are we actually more than that? So those are the unanswered questions as to how much of a release for the industry as a whole this really means. But yeah, if we just put our final slide up, Kenny, that perhaps gives a few areas on what this means and what next. Obviously we can't answer or claim to know the answers to all these questions. We kind of just put a few topics up here, and sure those are some of those that you're asking. But yeah, we open that up for questions and discussion, or can touch on some of these if there are no questions from the audience.
Thank you both. There's been a couple of questions that have come in, and we can go through them, and then if there's time available at the end, we can come back to these types of points. So, and I appreciate you may not know all the questions and answers to this, so feel free to say not known right now. But one of the first ones was what liabilities could be expected to be covered in future. There was mention of morbidity, but could it maybe even be all protection and with profits? Any views on that?
So the area that is probably most clear and has been lobbied for, so I've been privy to some of those conversations with Treasury as well, is on the income protection claims and payment. Now, those claims and payment share characteristics which have much of the features that would be appropriate to include as liabilities in the MA portfolio. The only feature they're really missing is the criteria for the matching adjustment in Regulation 42 indicates that they need to be only subject to certain risks, and those risks include mortality risk, but not morbidity risk. Now, morbidity risk is obviously inherent in that business, given how the claims come on. So the actual way the mechanism to get those included, and the fact that they share characteristics which are similar to mortality annuities, if you would call them that, these are morbidity annuities, is a way to phrase them, means that there's actually only a very simple change required, and there's some reasonable logic for putting them through. Other business, I think, is less straightforward and clear cut as to how they would make it in. So I mean, unless Anthony has a different view, although I would say that there's some other annuities like with profit annuities and deferred annuities, from memory, that were also stated in the original HMT consultation in April.
Anything to add, or?
No, I think that covers it well. I suppose on some of those other, with profit annuities and deferreds, obviously a number of firms have already, attempted in various ways to bring some of those in. Perhaps just the actual application process to do that might be eased, as well as broadening the range. So whilst you've had to make new applications perhaps for some of these aspects in the past, will that constraint be kind of slightly more flexible around what's required to bring the different types of liabilities in for firms that already hold a matching adjustment? Obviously, a protection writer that has a book of income protection that hasn't previously had a matching adjustment, that's probably slightly different, because they would need to go through that application process.
Then next one is, do you have any thoughts on how long it will take the Treasury to implement the decisions from yesterday? There's still some details missing, and any steps that the government needs to do after the decision yesterday? Yeah,
I mean, this is still very much obviously an open question. I think we heard from Jeremy Hunt that they would be looking to push the financial services reforms through, so not just Solvency II, but generally by the end of next year. I think we've heard from the PRA that their consultation on the reporting changes obviously runs till May, but the expectation that those reporting changes would come in at year end 24, at the earliest. So I suppose in terms of where that leaves consultations around the changes around matching adjustment and risk margin, for example, originally it had been stated that we should expect a PRA consultation by the end of this year. I think that's probably being pushed into next year. with no obvious consultation coming very much around the corner from the PRA. I think they may have even said in one of their speeches that would now be early next year. So again, it feels like certainly year end 24 would be the earliest, but possibly moving into 25. So again, the context of what does that all mean for industry? I suppose with the changes to the matching adjustment being less involved than perhaps previously, with the interest rates, meaning the risk margin is already reduced. Perhaps it's more a continuation, than major changes to Solvency II that perhaps have been thought about in the last few months. So yeah, that timeline is perhaps more easy to manage, but yeah, we do need to see more around what these additional requirements that the PRA may have around the attestations, the stress testing, and possible add-on, for different assets perhaps, and how it impacts the applications, not just for new assets, but major model changes for the SCR. Will anything be required there? So yeah, still quite a lot of uncertainty, unfortunately.
Yeah, lots of questions still to be answered. The other aspect that we might see some change on too, but I don't think it will come very soon, is that there has been mooted also changes to the standard formula, which has been quite outside this process, of course. But that was referenced in a speech that was to come in another phase or wave, but start and end date of that is yet to be clear.
Okay. Thank you. Maybe time for one or two more questions. So what's the latest situation with Solvency II equivalence for the UK? And do you have any views on how these changes might impact the likelihood of the UK framework being considered equivalent by the EU?
So there is a very interesting document, which I don't have to hand, and I'm struggling to recall the name of it, that was published about the middle of this year, or maybe a bit later, maybe more like August. That was UK Parliament, I believe, was assessing the whole equivalence situation, and it came back with its views on it. It stated, and some of this stuff is probably quite clear, that there's benefits to be had to becoming closer to our European counterparts, and that maybe hasn't been achieved so much in the last few years, and should be a focus. It talked about sort of that the UK is of course extended sort of equivalence to EU Solvency II rules, but that hasn't been reciprocated. Did suggest that there might be sort of political reasons for that, and I think the EU stated that the UK is clearly changing its rules, so they'll wait until that has concluded. So I guess that does seem to be closer to concluding now. So you would hope that might precipitate an answer on that, but of course you certainly need the political environment to be right for the progress we'd like to see on that, I suppose.
Yeah, I suppose an interesting kind of element to this on how much the kind of rules actually end up diverging. So if the matching adjustment isn't particularly being massively changed from the existing approach, the EU isn't really planning to change significantly the matching adjustment, but obviously not widely used across Europe, outside Spain. There's been some views around extra ability to allow for diversification benefits that the standard formula doesn't currently do, but that's the only real changes being proposed. I suppose the risk margin then is the more interesting aspect, where obviously a lot of the objectives around this was to show that, as having the ability to set our own rules, the government would want to be showing that there's benefits versus remaining with the Solvency II rules that were set with a European context in mind, and that we felt UK business is different and needs its own set of rules. That the idea that the objectives help promote the competitiveness of the UK insurance sector. If the risk margin in terms of how they modify it in Europe goes beyond UK, so that this is where the the interesting point comes around where the parameterization of it is set, given that we have longer duration liabilities in the UK and they're more sensitive to interest rates. So the change is more sensitive as well than in Europe.
Thanks. And I guess on that last one, do you feel this is going far enough to provide, value for policyholders, especially on products like annuities that are quite long term, or are there other further things that you guys would like to promote or see happen going forward?
Yeah, I mean, well, like I said, on the risk margin, I think we have slightly different views there, which could have kind of relatively sizable impacts there on balance sheets and how firms the value that firms offer to their customers. There's big questions around how these 4 items that Anthony stated on the matching adjustment will operate and how that will play out in terms of, will that mean greater agility for insurers on these assets, and in the matching adjustment portfolio more generally, which would be something a benefit would be nice to see from the reforms. But I think maybe Anthony has a more confident view, but I think without knowing how those will be implemented and conducted by the PRA, it's hard to make a strong statement on that for me.
Yeah, I suppose perhaps what my thinking is actually it's more just where the kind of economics go that impacts a lot of these things, and the reforms. We've managed to effectively get us back to a position we were hoping for, that the matching adjustment isn't being unduly kind of increased size of default and downgrade costs in the fundamental spread. It should allow you to continue widening the range of investments and hopefully bringing in more investments that support the kind of objectives that the government has, and generally the outlook for annuities, bulk purchase annuities, is probably better in a higher interest rate environment, where guaranteed products and the kind of, in terms of the pension schemes, their worries around liquidity and the crisis they've had probably means the outlook remains strong for the building of certainly annuity business volumes, and therefore you need a sufficient flow of assets to continue remaining competitive to offer those products to our retirement sector.
Okay, thanks. Maybe one final question from my side, given that I work a lot in it. That third objective about supporting provision of long-term capital for growth and climate change. Anything on the climate change part that you guys see that's good in here, or that we could keep lobbying for?
Probably one to keep lobbying for. I think it's not, to my mind, in the April consultation, and again in this November statement, there's not very specific comments that or amendments that really address that point, I think. So it doesn't seem to be very entirely front of mind, or at least it's not a direct, it's not being directly affected by these changes, but indirectly potentially.
Yeah. I think the ones that I kind of spotted was the cliff fall around BBB, and maybe some different assets being allowed, but yeah, you're right, it didn't jump out.
No, I mean, again, I'm not sure the BBB. I mean, some firms seem to kind of lobby a bit more strongly than others on this. That's perhaps elements to do with how they set their capital. But from the base balance sheet perspective, I can't see insurers suddenly wanting to hold 20% of their assets in sub-investment grade. You would have thought that kind of the risk kind of measures would still view that investment grade is going to be the majority of the portfolio. It may mean you add some elements of a particular opportunity where you would take a slice of sub-investment grade debt through that you might have been less comfortable doing previously. But yeah, I think where there are opportunities for firms to invest in assets that do have more of that kind of green variant to them, again, that's just part of the overall investment decisions they're making, and trying to bring it more into their investment thinking and framework than necessarily materially impacting the kind of pillar one treatments. Again, some firms perhaps thinking more on how they alter their internal model type calibrations, again, perhaps on a risk by risk basis. Are there particular elements where some kind of climate sustainability angle would mean you might want to alter the calibration. But yeah, I think we're still viewing it as it's quite difficult to model these things, but it should come into your wider thinking.
Okay. Thank you both. And with that, we've reached time. So I'll close the session. Thanks to all the attendees and all the participation through questions. And a big thank you to both our presenters for the effort and knowledge shared here. And have a lovely day. We look forward to seeing you at our next session.
Okay, thanks, Roelof. Thank you.
Cheers.